Most crypto reviewers couldn't pass a first-round buy-side interview. I'm not saying that to be rude. I'm saying it because I sat in those interviews for 4 years, and the questions I asked are the same questions I now think you should be asking before you put $1 into any crypto project. But almost nobody on this side of the internet is asking them. I'm Marcus, and this is Off the Tape. I spent 9 years in traditional finance, 5 at a European investment bank, where my first job was credit analysis, which is really just a polite term for figuring out who's lying about their balance sheet. Then 4 years on the buy side at a long-short equity fund in Singapore, covering financials and fintech. I left in 2023. The proximate cause was watching a former colleague, someone I respected, someone who would tear apart a bank's loan book for sport, buy a 6-figure position in a DeFi project on the basis of, and I quote, "The chart looks like it wants to go up." That was the moment I realized something was broken. Not with crypto, with how people, including very smart people, were analyzing crypto. When my friend looks at a regional bank, he asks 15 questions before lunch. When he looks at a token, he asks none. So I quit. I wanted to find out what happens if you take the toolkit that institutional investors have spent 80 years sharpening, and you actually apply it to this space. That's this channel. I've been watching crypto reviewers for 6 months. YouTube, Twitter, Substacks, the whole circuit. And I've come to the conclusion that there are 3 things they consistently, almost universally, get wrong, not because they're stupid. Most of them are smart. Most are well-intentioned, but they don't have the training. And the training matters. Let me walk you through them. Number 1, counterparty risk. When most crypto reviewers tell you about an exchange, Binance, Coinbase, some new platform, they tell you about features. The interface, the fees, the available pairs, the staking yields. When I evaluate an exchange, none of those are the first question. The first question is, if this company disappears tomorrow, what happens to your money? This is a question I asked about every counterparty I ever recommended in 9 years of finance. It is not optional. It is the first question. And in crypto, almost nobody asks it. So you get reviewers giving glowing recommendations of platforms with custodial structures that put your assets on their own balance sheet. No segregated client accounts. Holding companies domiciled in jurisdictions where, if something goes wrong, there is no court that will help you. Insurance policies that sound impressive but cover 1% of the deposit base. FTX wasn't a fluke. FTX was a structure that traditional finance has had centuries of guardrails against, applied to an industry that had spent 5 years dismantling them in the name of decentralization. On this channel, when I review an exchange, the first question is always, where is your money, who has it, and what happens if they're lying to you? Number 2, token economics. Token economics is a phrase that in crypto has come to mean, let me show you a pie chart of who owns the tokens. That's not analysis. That's just a pie chart. Here's what equity analysts do when they look at a new company's capital structure. They build a fully diluted share count. They map every vesting cliff and every unlock event for the next 4 years. They calculate the dilution impact on per-share earnings. They model the lockup expirations of insider stock. They ask, at current trading volume, how many days does it take for the next major unlock to clear the float? That is what real diligence looks like. And the equivalent in crypto is not just possible, it's easier because everything is on-chain. Every token unlock is visible. Every team wallet is traceable. Every insider transfer leaves a permanent record. But the vast majority of crypto reviewers will glance at a CoinMarketCap page. See, circulating supply 200 million, total supply 1 billion, and move on. That's not analysis. That's pretending to do analysis. When I cover a project on this channel, I'm going to show you the actual unlock schedule. I'm going to tell you when the next big tranche hits. I'm going to estimate in dollar terms how much sell pressure is 2 weeks away, because that information exists. We just have to look. Number 3, And this is the one I think is most under-discussed, the smell test. In institutional finance, there's a concept that doesn't get talked about publicly very often. It's the soft signal, the thing that doesn't show up in any model, but that every senior analyst learns to pay attention to. Why is the CFO suddenly retiring 3 months before an earnings call? Why is the company changing auditors right before a major refinancing? Why does the CEO keep posting cryptic things on social media? These aren't quantitative, but over a career, you learn that when something feels off, it usually is. Crypto has more soft signals than any market I have ever seen, and almost nobody is reading them. The founder of a $500 million project is replying to memecoin influencers at 3 a.m. That's a signal the Team Treasury wallet starts moving funds to fresh addresses 2 days before a big ecosystem announcement. That's a signal the Discord moderators are deleting questions about token unlocks. That's a signal half of crypto due diligence is just paying attention. On this channel, I'm going to pay attention. And I'm going to tell you what I see, even when it's uncomfortable, even when the project I'm reviewing is one that everyone on crypto Twitter is currently shilling. That's the deal. So how do I actually do this in practice? I built something called the Tape Score. It's a 7-dimension scorecard I use on every project, every exchange, every protocol I review. Same framework every time, no exceptions. 1. Team and track record. Are the founders public? Have they shipped before? Have they rug pulled before? You'd be amazed how often the answer to that last question is yes. 2. Token economics. The real version, unlock schedule, dilution model, float dynamics. 3. On-chain health. Are the revenues real or wash traded? Does the user count look organic? Is TVL parked by insiders or by actual users? 4. Regulatory exposure. What jurisdictions are they operating in? What jurisdictions are they avoiding? What happens when the SEC or MiCA pays attention? 5. Liquidity and counterparty. Where can you actually buy and sell this? What happens if the main venue goes down? 6. Narrative durability. Is this a structural trend or a 6-week hype cycle? 7. The smell test. Everything I just talked about. Each gets scored out of 10. 70 points possible. 4 to 5 and up, I'll say worth watching. 5 to 5 and up, worth a position. Below 30, stay away. You'll see this card at the end of every review I do. So here's what's coming on this channel. Honest exchange reviews. Project audits using the Tape Score. A weekly segment called Red Flag Friday, where I'll pick one thing the rest of crypto Twitter is hyping and tell you why it might be a problem. And a monthly digest where I read the institutional research, BlackRock, Galaxy, CD, Messari, and translate it into something useful. I'm going to be wrong sometimes. I'll tell you when I am. I'm going to miss things. I'll show you what I missed. And eventually, I will probably end up with affiliate links for some of the exchanges I reviewed. When that happens, I will tell you on screen, in the description, and in pinned comments. If I review a platform and I have a referral relationship with them, you will know before the review starts. That's the deal I'm offering. If that sounds like the kind of crypto research you've been looking for, hit subscribe. Next week, I'm going to use the Tape Score to review 3 of the largest exchanges in the world. Some of the results surprised me. I'm Marcus. This is Off the Tape. This isn't financial advice. This is the homework. End card with subscribe button.